0-100 to 0-30. Hook. What if there was a rule-based investing strategy so simple that you could execute it entirely in 10 minutes per month? And it has beaten the S&P 500 over 50 years with less than half the maximum drawdown? It exists. It's called dual momentum. It was developed by a former portfolio manager named Gary Antonacci. It uses 3 ETFs. And almost nobody in the retail investing world knows it. Today I'm giving you the complete breakdown. What it is, how it works, the historical data, and when it fails. Because understanding when it fails is as important as knowing when it wins. 0-30 to 130. Intro. Before we go further, a quick framing note. This strategy is not for everyone. It requires you to make one trade per month. Possibly. It requires discipline to follow the rules even when your gut says otherwise. And it has periods of significant underperformance relative to buy and hold that will test your conviction. If you want a completely hands-off strategy, contribute to a total market ETF every month and ignore everything else. That is a fully rational, historically strong approach. Dual momentum is an alternative for investors who want systematic risk management built into their strategy and are willing to manage one monthly check-in to get it. Today we're covering what momentum is and why it works in markets, the specific dual momentum rules and the 3 ETFs it uses, the historical return and drawdown data from 1974 to 2023, when the strategy underperforms, and how to implement it step by step. 130 to 330. What momentum is and why it exists. Momentum is one of the most robust, consistently replicated anomalies in finance. The finding: securities that have outperformed in the recent past tend to continue outperforming, and securities that have underperformed tend to continue underperforming. This effect has been documented across stock markets, bond markets, commodity markets, and currencies going back over a century. Why does it exist? Several explanations, none fully settled. 1. Investor underreaction. Markets are slow to price in new information, so trends persist longer than a perfectly efficient market would predict. 2. Herding behavior. Once a trend is established, more investors buy into it, perpetuating the trend beyond its fundamental justification. 3. Institutional constraints. Many institutional investors cannot buy into a trend until it has been validated by internal risk committees, creating delayed but consistent demand. Gary Antonacci's contribution was to combine two forms of momentum into a single, simple, implementable system. Absolute momentum, also called time series momentum, asks whether an asset has performed better than a risk-free alternative. T-bills. Over a look-back period, typically 12 months. If yes, stay invested. If no, move to a defensive asset. This is the safety valve that moves you out of equities entirely when markets are in a sustained downturn. Relative momentum. Cross-sectional momentum asks which of two assets has performed better over the same look-back period. This determines where to invest when you are in risk-on mode. 330 to 530. The 3 ETF rule. How it works. The dual momentum system uses 3 holdings. Show on screen. SPY, SPDR S&P 500 ETF, or equivalent U.S. equity fund. VEU. Vanguard FTSE All World ex-US ETF. International equities. BILL. SPDR Bloomberg 1 to 3 month T-bill ETF. The safety holding. The rule. Executed once per month. Last trading day works well. Step 1. Absolute momentum check. Asterisk: has SPY delivered a positive return over the last 12 months? Compare SPY's total return to BIL's total return over the trailing 12 months. If SPY's return is greater than BIL's, proceed to step 2. If SPY's return is less than or equal to BIL's, meaning equities are in a sustained downturn, invest in BIL. Done. Step 2. Relative momentum check. Asterisk compare SPY's 12-month return to VEU's 12-month return. Whichever has performed better over the past 12 months. Invest in that. That's your portfolio until next month's check. The result. You are always in one of 3 positions. US equities, SPY, international equities, VEU, or T-bills. BIL. You make at most 1 trade per month, and often no trades for months at a time when the signals remain the same. The logic is elegant. When global equity markets are trending up, be in the stronger one. When global equity markets are trending down, get out. No discretion required. 5:30 to 7:30. The historical data. This is where most people either get very interested or very skeptical. Let me give you the numbers Antonacci published. And let me also give you the important caveats. From 1974 to 2023, approximately 50 years of backtested and live performance data. Dual momentum approximate annualized return. 13.1%. S&P 500 annualized return over the same period. Approximately 11.4%. International. MSCI World ex-US. Over the same period. Approximately 9.6%. Maximum drawdown for dual momentum. Approximately 29 to 32%. 2009 was the worst period. Maximum drawdown for S&P 500 over the same period. Approximately 51 to 55%. 2007 to 2009 financial crisis. Dual momentum's Sharpe ratio. Return per unit of risk. Approximately 0.65. S&P 500 Sharpe ratio over the same period. Approximately 0.40. What this means in practice. Dual momentum has historically produced higher returns with significantly lower maximum drawdown. The lower drawdown is particularly valuable for 2 reasons. 1. It reduces the likelihood that you'll panic and sell at the bottom, because the strategy itself exits before the worst losses occur. 2. Mathematically, avoiding 50% drawdowns means you don't need a 100% gain to recover. The most significant wealth destroyer in investing. Important caveat. This is primarily backtested data. Backtests can overfit to historical market patterns that may not repeat. Antonacci has published live performance records since 2009, which are independently verifiable, and the results are broadly consistent with the backtest. But no historical return guarantees future results. 7:30 to 9:30. When dual momentum fails. Be honest about this. Here is the honest section that too many strategy promoters skip. Dual momentum's weakness is whipsaw in choppy, trendless markets. The 12-month lookback means the strategy is slow to respond to sharp, brief corrections followed by quick recoveries. If markets fall 15% in a month and recover within 2 months, the 12-month signal may have been positive both before and after. You stayed invested throughout and experienced the full drawdown. Conversely, if markets have a volatile, sideways year, up 8%, down 12%, up 10%, down 8%, the 12-month signal may flip from positive to positive, causing you to trade in and out multiple times, paying transaction costs and potentially taxes, while the market ultimately ends flat or slightly positive. Specifically documented periods of underperformance versus buy and hold. 2009-2010, equity recovery was sharp. Dual momentum was in T-bills during part of the rebound after the 2009 signal shifted. 2011, a brief correction triggered a defensive signal. Markets recovered quickly. 2015-2016. Multiple whipsaws in a volatile flat market resulted in unnecessary trading. Late 2020. COVID recovery was extremely fast. Dual momentum partially missed the V-shaped rebound. In strong bull markets with few sustained corrections, particularly 2013 to 2019, dual momentum often underperforms a simple buy and hold S&P 500 position. The strategy earns its keep in prolonged bear markets, which are relatively rare events. If you cannot tolerate 2 to 3 years of underperforming the S&P 500 during a bull run, dual momentum will not work for you psychologically. And psychological fit matters as much as mathematical optimization. 9:30 to 11:30. How to implement it today. Here is the step-by-step implementation. Show on screen. Account choice. Dual momentum works best in a tax-advantaged account, traditional IRA or Roth IRA, because monthly trades in a taxable account trigger capital gains events each time you switch from SPY to VEU or VEU to bill. You're selling an appreciated position and potentially owing taxes. In an IRA, there is no tax event on the internal trades. Brokerage. Any brokerage with commission-free trading works. Fidelity and Schwab are ideal because their IRAs have no account fees and support free ETF trading. The monthly check. 10 minutes. 1. Go to Yahoo Finance or any finance site. 2. Look up SPY 1-year total return and VEU 1-year total return. 3. Look up bill 1-year total return. 4. If SPY or VEU beats bill, pick whichever of SPY, VEU has the higher 1-year return. 5. If your current holding is already the winner, do nothing. 6. If you need to switch, place one sell and one buy order. Done until next month. Starting position. On day 1. Execute the check once and invest in whichever ETF the rules indicate. Minimum capital. Any amount. The strategy trades in complete ETF shares, so your minimum is 1 share of the ETF you're buying. Fractional share accounts remove even this constraint. 11:30 to 1300. CTA. Dual momentum is not a guaranteed outperformer. In bull markets, it often trails the S&P 500. In sustained bear markets, it has historically protected capital dramatically. For the investor who finds large drawdowns behaviorally destructive, who would genuinely sell during a 40% crash, the lower drawdown profile of dual momentum has real practical value beyond the return numbers. Antonacci's original book, Dual Momentum Investing, is linked in the description via Amazon. It's the most rigorous treatment of the strategy available to retail investors. With full data methodology, the Fidelity and M1 Finance affiliate links are there for account setup. Subscribe for 2 daily videos. Comment below. Are you a buy and hold investor or do you prefer a rules-based, active approach? No wrong answer. I'm genuinely curious where people land.